Hey, what's going on, everyone? Welcome back to The Real Workshop. We've got another amazing session today talking about a very technical topic, which is cost segregation with Kim Lochridge. Let's go! Welcome, everyone, to our next episode of our webinar series to help you guys all get better insights into real estate investing. Now, today we have a wonderful guest in Kim Lochridge. Kim is the Executive Vice President at Engineer Tax Services, and she's been specializing in real estate and energy efficiency incentives for over a decade now. She's also on the tax committee for the Real Estate Roundtable, a DC-based public policy organization that consists of some of the top public and private real estate entities. And she's also on the investment council for a family office. So she's very well-rounded. She's also got two daughters on the opposite ends of the political spectrum. So I'm sure she's recovering from a fun, love-filled Thanksgiving dinner. So did I miss any key details there, Kim?
That's pretty good. Thanks, Danny.
All right. So today, Kim's going to share her expertise around some of the key areas related to real estate tax strategy, namely how to supercharge your depreciation write-off, as well as keeping a pulse on new tax policies. So with that, I will turn it over to our fearless leader, Mr. Key Lee, who will fly us through today's session with Kim Lochridge.
Well, thanks for the intro, Dan. Kim, thanks for joining us. Glad to have you.
Thanks for having me. I appreciate it.
Yeah, so let's just start off by learning a little bit more about you. Could you tell us a little bit about yourself? How and when did you get started in your current profession?
Yeah, so let's see. I started with Engineer Tax Services in 2009, so about 11 years ago. And I've been an entrepreneur since I was 17, so I'm 48 now. So it's been quite some time, few decades. And I've been investing in real estate on my own, in pretty much the majority of my adult years. And then as far as starting in the field, I was looking for some services, actually. I was on the board of a $1 billion energy efficient manufacturing company in San Diego, and they were looking for services like 17090 services, which is an energy certification for real estate. And they were just basically saying, oh, this doesn't matter and whatnot. So I ultimately kind of seeked out, kind of an entrepreneur, as an entrepreneur would, seeked out some of the services myself, and ended up speaking with my now owner and CEO of the company, Julio Gonzalez. And it ultimately, he just was educating me, and I fell in love with the taxes. I've always been in finance and accounting, so it made all sense to me. For about a year and a half, he continued to ask me to go to work for him, and I kept telling him no because I'm an entrepreneur and I don't need a job. So ultimately, after about 2 years of not leaving me alone, I finally gave in and told him I would come on board as a subcontractor, and then ultimately took on a position a couple of years after that. So I started in this field quite a while ago, but as far as cost segregation goes, or tax services, but all in all, I've been in finance and accounting my whole life, so 30 plus years.
Excellent. Okay, well, Kim, could you tell us a little bit about depreciation and how it benefits the real estate investor, especially for some listeners that may not be very well familiar with depreciation or cost segregation. So let's start with like the high level, knowledge of what depreciation is.
Yeah, it's a great question, because a lot of people really don't know. And so depreciation is essentially if you buy a building for, it could be a single family home, it could be whatever. Let's say you buy a building for $1 million. You're going to be able to depreciate that building over, if it's commercial property, it gets depreciated over 39 years. If it's residential property, it gets depreciated over 27 and a half years. So if you take that $1 million and we divide that by, say, if it's residential, 27 and a half years, you're gonna be able to depreciate $36,363 each year for 27 and a half years. Okay, so that's kind of how straight line depreciation works. What that means is that there's a $36,000 deduction that you get to take against that income from that property. So as you have the rental income, let's say you have $50,000 of rental income that year, and you have a $36,000 write-off as far as your depreciation, then you'll end up having $14,000 worth of income that you pay tax on. So the depreciation actually reduces the income that you have to pay. So that's kind of how depreciation works on the building.
Now, does that mean the building is actually depreciating? I mean, that's what I thought when I initially heard about depreciating. Like, it just sounded like something that's negative, like my building is going down in value.
Yeah, so the building isn't necessarily going down in value because your building is going to appreciate as far as a market value goes, but for a tax value, it is being depreciated because essentially each year that you don't do anything with that building, those assets get older and older and older, and they begin to wear out. You have normal wear and tear like on carpeting or paint that you have to maintain in order to keep up the appearance and the value of that building, right? And so over time, those things tend to depreciate in value until you replace them. And that's kind of the overall concept of depreciation in itself, is that over time it's just going to wear out unless you replace it.
Yeah. So I think to sum it, the value of the building is actually appreciating, but for tax purposes, we can depreciate the building and deduct the income that we make from it. Does that sound about right?
That's correct. And in some countries, you don't depreciate. You don't get depreciation for a building. So it's U.S. tax rules. And Canada has similar tax rules. Mm-hmm.
That's why you live in the greatest country in the world, right?
Correct.
All right, well, let's move on here. So we talked about depreciation. Can you touch a little bit about what is accelerated depreciation and what is cost segregation and how that plays in for a real estate investor?
Yeah, I can. So, cost segregation, there's a lot of stuff out there on BiggerPockets and a lot of information about cost segregation. And so it's always good to understand it kind of in layman's terms, which is very helpful. But cost segregation is kind of what accelerated depreciation is, and I'll kind of give you some history. Cost segregation has been around since the 1940s. And in some capacity, and how it started, it wasn't just like a rule that was made. It was actually created by real estate investors who were, in the 40s saying, why should I have to depreciate this building? Back then in the 40s, they were depreciating over 31 years or even 20 years or something like that. But the tax rules have changed. But they would come and they would say, why should I depreciate my building over, 39 years or 30 years or whatever the depreciation rate is in that tax year, when there's no component of that building that's going to last that long? Your carpeting is not going to last 27 years. Right. Even a roof isn't going to last, say, 27 or 39 years. And so there was this argument. And so they would approach the IRS and the courts and said, hey, we don't think we should have to do this. We're going to do it our way. And then you can audit us and tell us, no. And then we're going to go to court over it. And these court cases were established. And so back in the 40s is when they originally started, when we can go back to the first court cases of that kind of started what we know now as cost segregation, because of there's been these pioneers in the real estate industry who have basically fought for our rights to be able to depreciate our building faster. And essentially what they're saying is, if you do a cost segregation study, which is going in and breaking down all the different components of that building. So you're breaking out what is carpeting, what is paint, what is walls, what's roof, HVAC system, plumbing, mechanical, electrical, all of that stuff, and you break it all down, then the IRS is going to allow you to depreciate those assets faster than that 39 or 27 and a half years, okay? So just like in the beginning of the analogy where we had the $1 million over 27 and a half years multifamily, we were depreciating 36,000. If you can depreciate some of those assets faster, then you get more write-offs up front, which is that form of accelerated depreciation. So essentially what's happening is IRS says, okay, since the CPAs don't know how to break down the buildings itself, they don't have the value, they won't be able to tell you how much the roof is worth, right? Then the IRS says, okay, we're gonna allow you to do this cost segregation study if you have a building professional come in and break down the different components of the building, where they can break out the mechanical, the electrical, and plumbing. They understand how the building is constructed and whatnot, and then apply a value to it. Now, if you build a building, you have all those assets, but if you buy a building, you don't have those. And so essentially we go in from Engineer Tax Services, and we'll come in and perform that cost segregation study where we're breaking down all the components of the building. As a result of that, there will be components of those. And I'll give you some examples. Like, for instance, we're talking about multifamily. In the multifamily situation, if you have 6 units or if you have 60 units, you have a lot of kitchens and bathrooms. And like, for instance, in the kitchen, you have appliances, okay? And so I think everybody here should know that appliances get to be depreciated over 5 years, because that's what the IRS deems appliances to be, is a 5-year class life. And you'll hear me use that terminology of class life throughout the podcast. But what is very interesting is if you have a cost segregation study done, the IRS says if you have an engineer who actually breaks down the mechanical, electrical, and plumbing, then all of the mechanical, electrical, and plumbing that service those appliances can also go into a 5-year class life. So let me give you examples of that. If you have a garbage disposal, a dishwasher, a refrigerator, a range, a microwave, right? All of those things have dedicated electrical. So they have an electrical plug behind that microwave that is dedicated just for the microwave. You have one for the range, the dishwasher, all those things. So that's electrical all the way back to the meter or the box, the breaker box. Can also be taken in 5-year asset along with those appliances. The problem is a lot of people can't break out how much electrical lines there are from that to the breaker box, okay? And so that's where the engineering company comes into play to break that down. But the IRS does say that you can indeed take that. Same thing with plumbing. You have the water lines that go from the garbage disposal to the dishwasher, or the dishwasher, the sink to the refrigerator. All of those plumbing lines, and the same thing with the drainage, all of that can go into a 5-year class life. So those are just some brief examples of what the IRS, if you didn't do the cost seg study, those assets would be depreciated over 27 and a half years instead of the 5 years that you're allowed. But you just have to have that study done in order to substantiate what belongs where.
Got it. Well, thanks for that explanation. Let me see if I can try to, summarize that. So like the traditional linear depreciation is, over a set course of time, let's say, 39 years, you get to depreciate the exact same amount every year. But then since a lot of the components will not last 39 years, we made this accelerated depreciation where some parts of the building can be depreciated on a shorter schedule. Instead of 39 years, we might schedule some depreciation for 5 years and others for 15 years, so that we can depreciate larger amounts in the first, say 2, 3, 4 years. Does that sound about right?
Yeah, that's good. And so like there's different class lives. There's basically a 3, a 5, 7, 15, and then your longer class lives that you can essentially break into. Most of the categories come in a 5, 7, or 15 year. 15-year class life would be something like exterior building components, like gravel, landscaping, plants, trees, curbings, gutters, signage, anything outside the building, driveways, sidewalks, that kind of stuff that you might own. All of that can get placed into a 15-year class life. So those are just some examples of how that works.
Got it. So let's try to put some numbers behind this. So traditionally, let's say the $1 million building, the investor can deduct $36,000 per year. But with cost segregation, the owner can deduct a lot more, especially in the earlier years. It could be maybe 100,000 a year or even more. And some of that deduction can be applied for future income or even past income. Is that right?
Yeah. So the way it breaks down is let's just say hypothetically 25. I'm just going to do some quick numbers real quick. So you say you have that same $1 million multifamily building, you would be depreciating 36,000. If you did a cost seg study, you end up, let's just say, on average, we get about 25% in a 5-year class life, so that's 250,000. And then we'll take another 100,000, which is 10% into maybe a 15-year class life. Okay, so total you have 25% and 10% that are placed into 5 and 15 years. So that means that the 250,000 that goes into the 5-year bucket, which is 25%, that $250,000 gets depreciated over 5 years because that's the 5-year class life. So if you take that $250,000 and you divide that by 5, essentially you're taking just in the 5-year, you're taking $50,000 a year for 5 years. Okay, so we will keep that number in mind. And then you have another $100,000, which is the 15-year class life, and you divide that by 15, you take another $6,700 there. Okay, and then that leaves, let's say, between the 250,000 and the 100,000, that's 350,000. So that leaves 650,000 left over that stays in the long time class life. So you divide that by, again, 27.5, and then you get another 23,000 there. So rough numbers, there's a double declining balance and in tax, and I don't want to get too taxy, but rough numbers. If you take the 23,000 of your long-term class life, you add that to your 6,700 for your 15-year, you add that to the 50,000 for each of the 5 years. Now, in basically from year 1 to year 5, you get to depreciate $80,000 in every year for the first 5 years, right? So you have more. Instead of 36,000, you have 80,000. So now, if that $1 million building was yielding you, we talked about $50,000, but that's kind of low for $1 million building. Let's say you had, cash flows, maybe your cash flows were 100,000, right? Or maybe they were 80,000. You basically just write off all of the income that you made on that property with your depreciation in the first 5 years. You don't pay tax. All that money that you saved on the tax. Now, let's say if you have an $80,000 write-off, and let's say you're at a 40% tax rate, that's about $32,000 in tax savings. Cash money. So that $32,000 over the course of 5 years, if you build that up, now you have enough down payment to go buy another building, right? So you're kind of saving that taxes because you're using that depreciation. And that's essentially the reality of cost segregation or this accelerated depreciation that we're talking about.
And that is phenomenal. And I would, I'm going to go out on a limb and say a lot of the commercial buildings, like apartments, the investment horizon is a little bit shorter. It's typical for it to be about 5 years. So if you can do cost segregation and write off all the profits, and then you sell the property, buy a new one, you do it all over again.
Mm-hmm. Yeah, and there are some things that there is something that's called recapture.
Right.
Recapture is essentially you're accelerating your depreciation to a certain point, and if you sell that building, if you don't retire off those assets, then you have to pay recapture on that asset. But there's ways around that. I mean, we have 1031 exchanges, which I'm sure you all know about, that would offset any of the tax gain. There's also what we're doing now is instead of doing a 1031 exchange, it's not a bad idea that if you're going to sell a property and you're going to upgrade into something bigger with higher cash flow, that you're ultimately going to take that, you sell the property that you're getting rid of, and then you buy another property in the same tax year. Then you can use the bonus depreciation from the new property to offset the capital gains on the old property without doing a 1031 exchange and still forego the tax. We haven't really got into bonus depreciation yet, and I think that's your next question. So,
yeah,
I might have let the cat out of the bag there, but
no, let's talk about bonus depreciation. Let's. What is it?
Yeah. So we've gone from straight line depreciation to our accelerated depreciation, which is essentially the cost segregation. And now I'm going to sound like an infomercial because I say, wait, there's more. So bonus depreciation is pretty exciting because so if you ran with me with the calculations, we ended up having 250,000 in a 5-year asset. We had $100,000 in our $1 million example for 15-year property. Okay, and so that was a total depreciation, accelerated depreciation of about 350,000 out of that $1 million building. Okay. So in 2006, George Bush introduced what was called bonus depreciation. So it's been around for quite some time and has just kind of gotten better over the years. And instead of going through the history of it, I'll basically just tell you what it is now. So it's kind of morphed. Jump starting in 2018, when we had the Tax Cuts and Jobs Act, President Trump ended up increasing the bonus depreciation and also expanding it. So it was limited to new construction or improvements. He opened it up to purchases and then increased it from 50% to 100%. What that means is that instead of having to depreciate that $350,000 over the course of 5 and 15 years, like we had talked about, the bonus depreciation means that anything that you reclassify into a faster class life, so these 5 and 15-year class lives, anything that's less than 20 years gets to be depreciated all in 1 year, the first year. And so what this means is that if you go buy a building, let's say I buy a building today, we're at the end of the year. If I didn't do a cost seg study on this building, I would depreciate a very small amount, because not only would you have to take that $1 million and depreciate it over 27 and a half years, but you'd only get 1 month of the 12 months of the year. Okay, so you'd have a couple $1,000s is all in depreciation. But by applying cost segregation and bonus depreciation, the bonus depreciation says that if you did the cost seg and the results of the cost seg were this 350,000, then essentially that $350,000 is a 1-year write-off. So you get to take a $350,000 deduction in year 1, even if I bought the building on December 31st. Okay, so you don't have to wait 5 or 15 years for the class lives. With the bonus depreciation, you get to take it all in that 1 year. Now, the next question is, what if my income is only $100,000 and, then I have this $350,000 write-off? Well, basically, you're going to use that for 3.5 years. You'll have $100,000 this year, then it rolls over whatever's left to the next year. You have $100,000 that year, and then $100,000 next year, and then you can use the leftover for the 4th year, that extra 50. So it does roll over if you don't use it. There was a question, and I don't know if you want me to answer this right now, but Art was asking about the question impacting the cost seg in regards to passive and non-passive income
Sure.
carryovers. So I think it's important to address that. So we have, and I think you guys all kind of teach this whole concept of being a real estate professional. And if you can get to that status, then your real estate income goes from passive to active. Okay, so if you're a real estate professional, or if you're a broker or a real estate agent, or if you have a spouse that's in real estate, that you qualify for this real estate professional, then let's just say hypothetically, we've taken this same example of this $1 million building, multifamily. We did a cost seg, we got $350,000. We took that in bonus depreciation, but your income from this property was only $100,000. But if you're a real estate professional, which means that all of this income is active income, which also means that your deductions are active deductions, then this $350,000 would not only offset the $100,000 in income from the property, but it would also offset your wages. Let's say, for instance, you have somebody who's a doctor, right? Their main practice is a doctor, but their wife is a real estate professional. She goes and does a cost seg study on the building that she just purchased. That $350,000 loss, obviously she gets to write off all of the income from the building, which in this case was $100,000, but then she can take the extra $250,000 and she can offset her husband's wages because her income and losses are now active. Okay, so there becomes a very interesting strategy around when it's active and when it's non-active or when it's passive. I think that's really key in, deciding your tax planning and making sure that, knowing that the depreciation from real estate investing, if it's passive, then it's going to be locked up with passive and you can only offset the income from that building or other buildings that you own. So you might own 3 buildings, and if you group them together, then you can take the losses from one and offset that cash flow. But you have to really plan that out. And it does matter whether that's, whether you're a passive investor or an active investor. So that's a very important question, Art. I appreciate you sending it.
Got it. So Kim, if I understand correctly, active income is for real estate professionals and passive income is for non-professional investors. Is that right?
Yeah, so let's say if your income comes from a real estate qualified, activity like maybe a real estate broker or a real estate agent, then that's going to be active. Or
Right.
if you, like in the case of this example I gave you where there's the doctor and then his wife is a real estate professional, maybe they invest in real estate and she manages their own real estate investments, she would have to spend 750 hours a year in order to reach that status, right? That real estate or rep status, real estate professional. And so then if she is qualified under that 750 hours or in her profession, then that becomes active for her. So all of her income is active and all of her losses are active, which then offsets his income if they are married filing jointly. Okay, so it's a little bit confusing. I know we're getting into a lot of tax issues, but they are really important to understand how you're structured and whether your income is passive or active and how it's going to impact you.
Got it. Got it. And Kim, I think we unpacked a lot of things. Let me see if I got the essence of everything we talked about. So depreciation is a way for the real estate investor to deduct their income where if they made, let's say, 100,000 in income per year in cash flow, if we can depreciate 36,000 a year, that's how much we can depreciate or deduct the income, the taxable income. Now, the accelerated depreciation is where we can take part of the property and depreciate them at a faster rate. So in the example you gave on the $1 million property, we can take 350,000 of that and depreciate that on a faster schedule so that for the first 5 years, the amount that we can depreciate increases. So instead of depreciating 36,000 a year, we can depreciate $80,000 a year, which could wipe out the entire taxable income for the whole year. Now, bonus depreciation is where we can take the entire $350,000 of shorter schedule, and instead of doing it over 5 to 15 years, we can depreciate all that in 1 year, where we can depreciate $350,000 for year 1. Is that right?
That's correct. Yes.
So that's just really powerful way to just optimize somebody's taxes. I mean, this can be a game changer, especially for someone who has a shorter investment period, let's say 5 years. They can come in and do cost segregation and do the bonus depreciation and get a bunch of deduction in the beginning, sell the property, buy a new property, and do it all over again.
It is a strategy, but you have to be very careful with that recapture and make sure that you're working very closely with your, with your CPA, if that's the strategy that you're going to use. But you'll need to make sure and do those things in the same tax year, or elicit the assistance of a 1031 exchange if they're still around. I know there's a little bit of threat that those 1031 exchanges may go away.
Right.
But if they're there, it's definitely a tax strategy, because you don't want to take all that accelerated depreciation and then end up having to give it back, if you sell the property. So you wouldn't do this on a flip. You wouldn't do this on a property that you're going to buy renovate, and then turn around and sell the next year. It's just not
Mhm.
going to be worth it for you to do that. So it just depends on, working with that. And that's where I come in with the consulting side of it and really help folks determine whether they should do this or not do this up front before you ever, get
Mhm.
suckered into it. I mean, don't just go pay for a cost seg study. I have horror stories where, somebody out there found a cheap cost seg study online. They paid for it, got it done, brought it to their CPA, and they were all proud, like, hey, I did a cost seg study, implement this into my taxes. And ultimately the CPA goes, well, I don't even know why you even wasted your money, because you can't even use this, right? So you need to make
Mm.
sure that you have a tax strategy in place that it's beneficial for you before you move forward with it.
Got it. Now, Kim, you mentioned there that the 1031 could be going away with the new administration. Can we talk about some of the new legislation that could affect cost segregation, accelerated depreciation, and other aspects of real estate investing?
Yeah. So, okay. So I just did a webinar just recently with Ryan McCormick, who's the vice president of the Real Estate Roundtable in Washington, D.C. So I hosted him. We talked about a post-election tax update, as to what we think is going to happen. Everything is still pretty much up in the air, but we have an idea. We have a Biden's tax plan, which is on his website. You can read that. I strongly encourage you to read that so that you can get prepared about what might be coming down the pipeline. But the first thing he says is he's going to do away with the Tax Cuts and Jobs Act. So whether he does or whether he's capable of doing that, I think remains to be seen. Ultimately it's going to depend on the Senate and who takes control of that in January. But essentially, what we have to remember is that depreciation or cost segregation isn't anything extra. Okay, just because you're getting more depreciation up front doesn't mean that you're getting more. Okay, it's the same amount whether you depreciate it now or over 39 years. And so I always use the analogy that as an investor and as a real estate investor myself, if I won $40,000 on a scratch-it ticket, and they came to me and they said, hey, we'll give you $37,000 right now cash, or we'll pay you $1,000 a year for 40 years. I would take the $37,000 because I know the value of the money now. And most people would, as long as they can invest it. But maybe that person is really bad with money, right? Maybe they don't know how to invest it. They don't know how to make that grow for them. And they know in their mind that they're just going to blow it. They would rather have the $1,000 a year for 40 years. They may take that. That's basically what cost segregation is. It is a tool. You're not going to go build a house with a hammer. You're going to need all kinds of different tools, right? So using cost segregation should be a tool in your tool belt. It should not be the only tool, right? You want to use 1031 exchanges. You want to use bonus depreciation. You want to use strategies of improvements and when to do those improvements to help you build that tax portfolio. So going back to my my question about the legislation, it's the same money. Just because you're getting bonus depreciation, you get more now, you are getting less later, right? So let me give you an example. Back to our $1 million analogy with the 350,000. We already know that if you didn't do cost seg, you'd get 36,000 a year, right? So if you did the cost seg, you'd have 650,000 left over. So essentially, what we talked about, you'd get $350,000 in year one with the bonus depreciation, and then you would end up getting $23,000 a year every year after that instead of 36. Okay, so you have this little bit of arbitrage. You're not going to get the 36,000 that you would every single year for 39 years. You get a big bump up with the first year for the 350,000, then you get 23,000 every year after that. So it just reallocates the depreciation. This is why I feel like I don't know that bonus depreciation is going to be going away, because first of all, It's only good through 2026, so it begins to sunset in 2023 when it goes from 100% to 80% and then 60, 40, and 20, and then it's ultimately gone in 2027. So my thought process is if I'm the new president-elect and I'm coming in and I'm going to do away with bonus depreciation, I can't claim that I just, regained how much millions of dollars or billions of dollars in tax recovery, because I didn't, because it's the same money. Whether I get it now or later, it's the same money. So it isn't a bonus. And it's also helping the economy continue to grow. And that was the original idea behind it, was to increase the GDP. Keep in mind also that bonus depreciation was enhanced by Obama in 2011. So this is more of a bipartisan tool that anyone in government will use to turn on and turn off when it sees fit for the economy. I don't see bonus depreciation going away. 1031s are probably at risk, and that's because we have bonus depreciation. So I wonder what's going to happen. Are they going to do away with 1031 exchanges? And then as bonus depreciation phases out, are they going to bring 1031s back, or could they? I don't know. That's a little bit of more of a sticky situation. I think that would be a huge win for Biden, since he does want to kind of get more money from the wealthy. I think he would probably do away with that, because that is a win for them, that they could say, hey, we're going to regain this much in tax dollars by doing away with 1031 exchanges and make everyone pay their capital gains.
So there's talks about 1031 exchange going around. Obviously, it's not just up to Biden. It has to pass Senate, pass House, and everybody has to approve on it. Same thing with going away with bonus depreciation, but you think, for the reasons you mentioned, it's probably not going to go away. Are there any other significant changes that we can expect from 2021?
Your tax rates will go up. I mean, that's the bottom line. They will go up. And if your tax rate doesn't go up, it's very clearly laid out in Biden's plan. And I know that there's a lot of advertisements out there that if you're making less than $400,000 a year, that your taxes will not go up. But ultimately, even if your taxes don't go up, because the taxes are being raised on businesses and people who make money, it is going to be a trickle-down effect. So costs are just going to be higher across the board, regardless. We know that capital gains tax is probably going to be increased. We know that the tax rate is going to go back up to 39.6%, so it's at the highest level. So we can expect that there will be changes. As in any tax rule, there's always changes. But with the new president, I do think that there's going to be tax increases across the board, especially in the real estate. We've been very fortunate to have a real estate president for the last 4 years. And, hopefully everyone has been able to utilize some of those benefits in the taxes. I will tell you, and I think this is important to note, just because we're trying to get the word out, I'm working directly on Capitol Hill to try and get a bill that essentially extends this look-back period. But right now, the way it sits, the 2020 is the last tax year that we are able to go back retroactively to get bonus depreciation that we were due but didn't take it. So let me give you an example. If you bought a building in 2018, if you bought a building in 18 and you put it on a straight line depreciation, right now you can go back and do a caustic study on that. It would qualify for bonus depreciation. You can get the bonus depreciation and bring that forward into your 2020 tax year without having to amend your taxes. In 2021, that turns off. You will not be able to go back and get retroactive bonus depreciation. So basically, the reason for that is because we've had this bonus depreciation rule since 2017, the increase. And what the government is saying and the IRS is saying is that you've had 3 years to know about this. And if you didn't go back and get it by now, you must have just decided you didn't want it, and so you didn't make the change. And so what they're saying is you're going to cut that off. And so 2020, this is the last tax year. So if anyone owns property, that was purchased at the end of 17, 18, or 19, that they put it on straight line depreciation and they want to go back and do a cost seg study and claim their bonus depreciation, this is the last year to do it. Also, interestingly enough, is that we have the CARES Act, which was for 2019 and 2020. And what that says is, let's say, let me give you an example. Let's say I bought 5 buildings in 2018, okay, and I put them all on straight line depreciation. And didn't really know about cost segregation. Then in 2020, I come in and go back and do a cost seg study on all of those to get my bonus depreciation. And I take this huge loss into 2020, okay? Far more than I need as far as my income goes. All right, so it's in excess. Because of the CARES Act, we are allowed in 2020 to carry back those losses to 5 previous tax years and get refunds on those taxes that have been paid previously. So you can use cost segregation right now. You're going back to say 2018 or 2019, do the cost seg study, claim the bonus depreciation. You bring that forward to the current tax year using a change of accounting method. Okay, so you don't have to amend the taxes, but it will plop into the 2020 return. And then when you file your 2020 taxes, if you have a net operating loss, you can take those losses and carry those back to the 5 previous tax years. You get huge income, cash flow back in your pocket. But again, this is the last year that you can do it. And you have to file an on-time filing. It's not on an extension for the look back on cost seg. So these are points that we want to try and get those across. There is this urgency to be able to get these things done and get your books square to what was eligible to you at the time, and get that taken care of, and really help you with the cash flow when we can.
Got it. Wow, that was a lot of amazing information. Do we have any questions from anybody for Kim? I know Art.
I got if it's a
Art, go ahead.
Question, but this one actually gets into a tricky part of it too. So, assuming we have multiple buildings that we haven't done a cost study or looking at potential 2020, but we qualified as a rep in 18 and 19, but 20 is not going to be a rep year. And so the question is, if we did a cost study in 20, it would obviously carry forward for passive for 20, 21, et cetera. But in that look back clause or acceleration of the CARES to go back, would that be able to count against 18 and 19 and then 20 as a passive carryover? I know it's a little bit of a nuance on that one, so I don't want to take away from the rest of the group, but I'm just trying to think about that kind of a nuanced situation.
Yeah, so let's think about this. So you're a rep, you have rep status or real estate professional status in 18 and 19, but you do not in 2020. And you bought properties in 18 and 19. You can go back and do cost seg on those properties and bring them forward into your 2020 tax year. Those will be active, and those losses can be carried back because those were active at the time, right? Yep. In 2020, if you acquired property in 2020 when you were not rep status, that's going to be passive and cannot be carried back. So it's going to be delineated between the two.
Kim, I have a question. So earlier you mentioned about recapture. So can you explain that a little bit? Because it is my understanding that you can depreciate. Let's say you depreciate $1 million building down all the way down to 0. So when you sell it now, let's say you sell it for $2 million. Now you owe taxes on $2 million of gain instead of $1 million. So how does the recapture work? With cost segregation and accelerated depreciation. Is there a way to mitigate that as well? Can you explain on that a little bit?
Yeah, there is a way to mitigate that. And again, it goes back to having kind of your tax team in place and making sure that you're making these decisions, at the right time. So in your analogy where you have depreciated this building to zero and you sell it for $2 million, your accumulated depreciation on that building is going to be $1 million, right? Because you bought it for $1 million. So essentially, you're going to have you sell it for $3 million, you bought it for $1 million. Not only do you have the $2 million gain, but you also have $1 million of depreciation. Accumulated depreciation. So your tax bill, you're actually going to be paying tax on $3 million, not $2. Okay, so that's kind of how recapture works. What you want to do is one of the 2011, there were regulations that came out that really addressed improvements on a building. And how to treat those improvements. And this kind of gets into a little bit more of the weeds, but let's say, for instance, I'm trying to figure out how to talk about this in layman's terms so everyone can understand it. But let's say I buy a building in 2015. I bought it for $1 million. And in 2016, I did, say, $500,000 worth of improvements to that building. Okay. Maybe it was multifamily. I went in and redid all of the cabinets, the countertops, the kitchens, the bathrooms, the flooring, the paint, all that, put on a new roof, new HVAC system, just redid as much as I could in that building. Spent $500,000. The assets that are, going back to the $1 million purchase, we could depreciate that over straight line, but we could also do a cost study on it. So let's assume we did a cost study on it. Now we have all the different breakdowns of the building, okay, all the different assets. When I do the improvements, I get to capitalize. I take that $500,000 and that is a capitalized expense. So I get to start depreciating the $500,000 too, right? But also what's very, very, very important for the maximizing your or minimizing your recapture or maximizing your tax benefits is that when you do those improvements, you want to go back to the original building and remove the assets from the books that were taken out of the building. So let's say you took off, so I bought it in 2015, I put a new roof on in 2016. But when I started appreciating it, roof is a structure, so that stays in 27.5 years regardless, okay? So it doesn't, even if I do cost seg, that asset stays in the 27.5 years. So I do a new roof. Well, I'm depreciating my roof in the $1 million, right? It's there, it's part of that $1 million purchase. And I'm depreciating that over 27.5 years. But I just went and spent $100,000 on a new roof the next year. So I'm depreciating this one for 26.5 more years. This one I have to put on the depreciation schedule for another 27.5 years. Okay. So now I'm depreciating 2 roofs. Now, remember when we talked about recapture calculation is your gain plus your accumulated depreciation. So now you're accumulating depreciation on 2 roofs, not one, because you're depreciating them both. So what the law now gives us the ability to do is called partial asset disposition. We want to remove the depreciation from the first one when we put the new one on. So now we're taking that off the building, and therefore you're not going to be accumulating depreciation on that original roof anymore because it's gone, right? So you took a write-off. So not only did you depreciate the new roof, capitalize it, but you got to take an expense for the remaining 26.5 years that you had from the other roof. And that's the power of understanding how much each asset is worth. If you did straight line depreciation, you would never know how much that first roof would cost. You didn't know how much of that $1 million was the roof. In this case, by doing the cost seg, we tell you exactly how much it's worth. Now we get to prorate it and say, now we get to take off 26.5 years. That's called partial asset disposition. Partial asset disposition is extremely powerful. And again, it's another tool in the tool belt. If you're doing cost segregation and you're doing improvements, you want to make sure to do the improvements, take off the old assets that are being removed so that you can take that partial asset disposition, not only an immediate expense in the year that you took it out of the building, but along the ownership, you're going to be minimizing your recapture as well.
Wow, that's a lot of different things we can do, even in the realm of depreciation and cost segregation. That's just really a game changer for, I think, a lot of people that didn't know about accelerated depreciation and cost segregation. And like you said, it's just one of many tools that we can use to optimize taxes. It's mind blowing.
Yeah. So Kim, let me ask you, why do you think the vast majority of people, like we have a wide network of friends that have real estate investments, why do you think the vast majority of people missed this or didn't really think about cost segregation as we talked about how impactful it is today?
There's a lot of reasons for that. It starts with the CPA. And I will tell you, I just had an email yesterday where a client was looking into doing cost segregation, and they said, hey, we're talking to ETS about doing this. And she came back and she says, well, I don't know why you want to do that. It's the same money now or later. It's the same depreciation. But again, I'm talking to you guys who are all investors. We're all investors. We're not the CPA. And so the CPA looks at that and says, oh, well, you're just appreciating it a little bit faster. You're going to get it eventually. But to me, that's like saying, okay, I'm not going to take my $40,000 of lottery winnings right now. I'm going to take the $1,000 a year. Well, what I can do with $37,000, even if it's a reduced $40,000 amount, right? I can do was more powerful if I can invest that, in something to where I'm creating more cash flow for myself using that money, right? If I got $1,000 a year, I would literally eat it. I would spend it on groceries because it's nothing. I can't do anything with it. So it's just a little extra cash flow that I just blow. So from a CPA standpoint, if they're not an investor, they're going to just, of course, see it as, oh, well, it's just the same money. It's the same $40,000. They might as well just wait and get it over the course of 40 years. Right. Well, shit, I might be dead in 40 years, right. I'm going to get it now. So I look at it as an investor and I say, well, what can I do with this fund right now? And what can I do with this money right now as an investor while I'm building my portfolio? So I think it starts with the CPA. We get a lot of CPAs that just don't really get it. They don't understand the investing side of it. That's the first place. The second place is that there's a lot of myths out there. In fact, I wrote an article that was published in Accounting Today a couple of years ago, and it talks about all the myths around cost segregation. And one of them was recapture. Well, if you just take the money now, you're just going to give it all back in when you sell it. But that's not the case either, because times have changed. And so now we have this partial asset disposition. And not only is it a deduction right now, but it's a deduction that can pay you back year over year over year. And that's how those cost segregations are designed. I think there's a lot of different, there's myths out there people hear and they just go, oh, well, this wasn't good for me. But if again, I'm going to go back to my building a house with a hammer. If I'm going to build a house with just a hammer, that's all I have, that house is going to be pretty crappy, right? That's the same thing as if you're incorporating your tax strategy with cost seg and not using anything else. You're not using partial asset disposition. You're not using 1031 exchanges. You're not using all these other strategies out there. You're going to have a really crappy portfolio. Right? Yeah. Because you're going to end up hurting yourself in the long run, and your buildings are going to fall down or your finances are going to fall down. Then you're going to blame the cost seg study, or in this case, the hammer. It's not the hammer's fault. You just didn't get enough tools, right? So I love analogies because sometimes it just hits home, but really that's the problem. And, then you have these CPAs out there that are trying to do the cost segs themselves. But if the CPA is the family practice doctor and ETS is the brain surgeon, I'm not going to have my family practice doctor do brain surgery on me. Yeah. I'm sorry. I'm just not. They don't know enough about buildings to be able to do that. And just like I'm not going to go do somebody's taxes because that's not what I do. I'm the brain surgeon, right? I don't treat you for the flu. That would cost you way too much money to have me do it. So if you understand those analogies, and that's kind of what it is, building that tax team, building that toolbox of tools, that's really the bottom line. And I love your question, Danny, because so many people every day, I get that. It's just literally yesterday, that CPA, and I just close my eyes and they just don't get it. They don't. Yeah. I'm an investor. I don't see things that way.
Yeah, no, I think that's an important question because a lot of CPAs, even mine, didn't know about it. And until we had our conversation, and for those of you guys on the webinar, Kim's going to be doing our cost segregation study for our multifamily apartment. And so until we had the conversations and were able to learn more intimately about this tool, there's not that many people that really know about it. And that's a bit sad, because this is one of the greatest sort of tax benefits for any real estate investor out there. So in any case, we're coming here on the top of the hour. I just want to thank Kim for joining us today. This was incredibly insightful. I think, the key takeaways are taxes are going up, fire your CPA, and hope that Trump
or just
wins
have him call me.
yeah, or have him call you, or just become a real estate professional and marry someone rich, right? So you can help them with their deductions. No, but we learned a lot today, and for everyone, we're going to send links out to your with your contact information, Kim. So I know that you're open to doing a initial consultation to explore if there are opportunities for cost segregation studies for everyone here that has an investment property. And so we'll send out your contact information to everyone, as well as let's see, maybe some of the other resources. I know you have some webinars, et cetera, on your website as well, that people can look up. So Key, anything else before maybe we conclude here?
No, Kim, thank you so much for joining us. I learned a lot.
Good, I'm so glad. And thank you for having me. I really appreciate the opportunity to share the knowledge here, because I do think it's very powerful.
No, it was, and it is. So great. Well, thanks everyone for joining. We'll talk again soon. Thanks for joining us today. You can find more episodes at therealworkshop.org.